This video wraps up the accounting cycle for Gulf Coastal Design Studios. It's December 31st. Every account has already been adjusted, and our job has three parts to it. Build the adjusted trial balance, journalize the closing entries, and figure out how many accounts survive onto next year's books. As you can see, you're given a list of accounts, starting with cash, ending with interest expense, with all their adjusted balances. Each amount needs to go into the debit or credit column based on its normal balance. Assets, dividends, expenses all go on the debit side, with one exception. Accumulated depreciation is a contra asset, so even though it lives on the asset section, it carries a credit balance. Liabilities, common stock, retained earnings, and our revenue accounts go on the credit side. You may want to pause the video at this point in time and make certain you understand why each balance is where it's located. Now let's add up our debit and credit columns. As you see, debits and credits both land at $1,940,000. They match. Our adjusted trial balance is in balance, and we're ready to move forward. Most companies prepare an adjusted trial balance monthly. The adjusted trial balance serves as the information source for financial statement preparation. At year-end, the adjusted trial balance not only serves as the source for financial statement preparation, but it also provides the data needed to close the company books. Before we close anything, let's pull 6 numbers straight out of this trial balance. Total assets. To get total assets, we're going to add cash, accounts receivable, supplies, prepaid insurance, and property, plant, and equipment, or PP&E. They add up to $1,080,000. Subtract out the contra asset accumulated depreciation for $250,000, since it reduces what our assets are actually worth, and we get total assets of $830,000. Net property, plant, and equipment, or net PP&E, also called book value, is $1 million minus the $250,000 of accumulated depreciation for $750,000. Total liabilities are the sum of our 5 liability accounts. They add up to $246,000. For net income, we add our service revenue from design, service revenue from consulting, and subtract all the expenses we have listed. Our total revenue from the two sources is $965,000. We subtract our total expenses of $810,000 to get a net income of $155,000. When it comes to determining ending retained earnings, we take the beginning balance of retained earnings, which is in the trial balance, for $179,000. We add the net income of $155,000, subtract the $50,000 of dividends, and we get an ending balance for retained earnings of $284,000. The ending stockholders' equity will always be the common stock amount plus the ending balance in retained earnings. Common stock is $300,000 plus our ending retained earnings balance of $284,000 equals $584,000. Hold on to these 6 numbers. We're about to prove 2 of them with closing entries themselves. Time to wind things down. Let's take a look at journalizing and posting the closing entries, getting retained earnings up to date, and then finally preparing a post-closing trial balance. Closing entries do 2 things. They bring every temporary account, revenues, expenses, and dividends, back to zero for the new year, and they roll their balances into retained earnings, where permanent year-over-year balances live. Think of the accounting period like a basketball game. At the end, you record the final score. That's transferring everything into retained earnings. And then you reset the scoreboard to zero for the next game. Without closing, next year's revenue would start out mixed together with this year's. Journalizing closing entries is a 3-step process. And there's an easy way to remember the order. RED, R-E-D. Revenues first, expenses second, dividends third. For our first entry, we'll debit service revenue design for its full balance of $750,000 and service revenue consulting for its full balance of $215,000. The credit is to retain earnings for the total of $965,000. Our second entry will debit retained earnings for the combined total of all 6 expenses. That total is $810,000. Then we'll credit each expense account individually for its own balance. $8,000 for supplies, $650,000 for salaries, $7,000 for utilities, $90,000 for service fees, $50,000 for depreciation, and $5,000 for interest. All these expenses get credited to close them out. Entry 3 closes out dividends. Here we'll debit retained earnings for $50,000 and we'll credit dividends for $50,000, bringing its balance to zero. Now that we've journalized each of the 3 entries, we're ready to post to the general ledger. At this point, we're going to transfer those balances from the temporary accounts to retained earnings, which is a permanent account. While the journal entry amounts are posted to each account in the general ledger, let's focus on retained earnings. It's important that you realize that the retained earnings balance of $179,000 on the adjusted trial balance is a snapshot from the beginning of the year, and it stays that way all year long. Unlike most accounts, retained earnings isn't touched by day-to-day transactions. Its only path to change are the closing entries. At closing, we post the 3 entries to the general ledger T account for retained earnings. The beginning balance is $179,000. The first entry transfers the total revenue of $965,000 to the credit side. The second entry transfers the total expenses of $810,000 to the debit side. The third entry transfers the dividend amount of $50,000 to the debit side. The temporary accounts are zeroed out and their net effect flows into retained earnings. For the first and only time all year, retained earnings has changed. The ending balance of retained earnings is the beginning balance of $179,000 plus the revenue posting to the credit side of $965,000 minus the expense posting to the debit side for $810,000 minus the dividend posting to the debit side of $50,000 for a total of $284,000. That's the new ending balance. Throughout the year, revenues, expenses, and dividends have done all the work. These temporary accounts track the current period's activity so we can measure performance with the income statement and distributions by looking at dividends before rolling them into the company's permanent account. Once the closing takes place, the updated balance becomes part of a permanent cumulative total that carries forward for the life of the company until the next closing, when the cycle repeats itself. Retained earnings, along with the other permanent accounts, make up the post-closing trial balance. As you can see, we have 6 asset accounts, 5 liabilities, and 2 stockholders' equity accounts for a total of 13 accounts, all with debits equaling credits at $1,080,000. That's it. With the preparation of the post-closing trial balance, the accounting cycle comes to an end. Thank you for watching this video. At this point, you should be familiar with the accounting cycle that's followed by all companies. Take care.